Investing Insights. I'm Sarah Hansen, a markets reporter at Morningstar, and I'm filling in for Ivana Hampton today. We're on the podcast stage at the 2024 Morningstar Investment Conference at Navy Pier in Chicago. And today we're talking about active ETFs. These have soared in popularity kind of seemingly overnight. They're gaining market share at a rapid clip. And they're being recognized as a long overdue opportunity for active managers, and not to mention a new cost-effective tool for investors. So what is driving all of this growth? Luckily for us, from Morningstar Research Services, we have Bryan Armour, who's the Director of Passive Strategies Research for North America. We have Daniel Sotiroff, who's a Senior Manager Research Analyst. And we have Ryan Jackson, who's a Senior Manager Research Analyst of Passive Strategies. And they're here to tell us everything investors need to know. So thank you so much for joining me. So first things first, Bryan, maybe you can help me with this one. What are active ETFs? How do they work? And how are they different from passive ones?
Yeah, great question. So ETFs are really just mutual funds that trade on a stock exchange. And so structurally, they're very similar. The big difference is they tend to be a bit more tax efficient. So last year, 4% of ETFs distributed capital gains, 60% of mutual funds did, and they tend to be lower cost. So ETFs tend, like if there's a similar mutual fund, an ETF would be coming at a cost that's similar to like the institutional or retirement plan share class fee level. So both very easy wins for investors. It's clear why investors are excited about them. And then in terms of active versus passive, it's really just passive will track an index. There's a methodology, what they're putting in their portfolio, when, how much is all dictated by an index. Whereas for an active manager, they would actually have discretion over those decisions.
Great. So a lot of the growth we've seen has been on the active side. Ryan, maybe you can tell us what's driving that momentum and if you expect it to continue.
Yeah, ton of momentum into active ETFs. It's been fast and furious. Just to kind of put it in context, you look at active ETFs at the end of May of this year compared to 3 years ago. Today have about 4 times the amount of assets and 3 times the number of products. So there's been a huge proliferation, not just in the number of products available, but the money that actually sits inside of them. And when you think about what's really driving that growth, I tend to look at it kind of both from a supply and demand angle, both things kind of working together. So on the supply side, the big catalyst was the ETF rule passing in 2019. And this was a piece of SEC legislation that made it a lot easier for providers to even bring ETFs to the market in the first place, and B, for active managers to use custom baskets to create and redeem new shares. So without getting too far into it, really allowed them to tap into the tax efficiency of the ETF vehicle. So since that passage of the ETF rule in 2019, we've just seen the number of products available to investors really skyrocket. So that's the supply, but that's no good if there's not actual demand for those products, and there's definitely been a ton of that. I think it took a little while for investors to kind of get comfortable with the ETF as a structure, maybe disentangle the idea of ETF and passive, which had existed for so long. But once that happened, we've seen them warm up to the transparency, the tax efficiency, the cost advantage that comes with ETFs, and that demand has certainly taken off since.
Great. And, amid all this momentum, there's been some that have been more successful and gotten a lot more uptake than the rest of the pack. Dan, why has that happened and what's driving that?
Yes, so maybe just take a step back and what has been really successful. Like when we look at the leaderboard, there's some clear winners out there, right? We have JP Morgan Equity Premium Income, which I think is number 1 or number 2 based on the table you guys put together in your research. That's a covered call strategy, essentially, that's based on the S&P 500. They have another one, JEPQ, which is based on the NASDAQ 100. And then JP Morgan has another ultra short-term bond ETF that's actively managed that's done very, very well in terms of gathering assets. So when I look at those 3, it really screams income to me, right? Like the short end of the curve is the higher yielding segment of the curve right now. So you're in ultra short bonds. And then those covered call strategies are really more of a novel income play that we've seen come out over the past few years. So those 3 are really saying income to me. The rest of the list is, it's no surprise to me, but the rest of it is a lot of DFA and Avantis type stuff out there. So very low cost, very broadly diversified ETFs at the end of the day. It's very easy for a lot of advisors and investors to kind of rationalize those types of things in their portfolio. Being that they're broadly diversified, it's very easy to understand, how these things are going to perform, why they've outperformed or underperformed over any given period. So it's very easy stuff to understand, very low cost too. They have a massive fee advantage over a lot of other actively managed funds. So they've been doing very, very well. The other thing with that dynamic though is when you look at DFA, we've seen a lot of outflows from their mutual funds and a lot of inflows to their ETFs. So I think some of that is just their advisors and their investors rotating out of the mutual funds and into the more tax efficient. Like Bryan was saying before, ETFs are just a tax efficient wrapper to get into. So I think that's really what's driving a lot of the success on the DFA and the Avantis side of things.
Great. And what about the other side of the coin, the ones that just aren't as popular? What's happening there, and why aren't they getting picked up?
Yeah, so I guess the number one thing I would say is obviously we all live in the ETF world every day, and so we talk a lot about low costs, and that's no surprise. It's basically table stakes in the ETF market. So high fee strategies, traditional mutual fund managers that are able to charge high fees have not had a ton of success in the ETF wrapper. It's not a panacea. Like everyone doesn't just automatically catch the trend by launching an ETF. So that's one area where it hasn't worked, and there has not been a ton of new product development. Another one is ETFs can't close to new investors. So capacity risk is something that active managers have to think about, especially in more niche areas of the market. And with a mutual fund, if your strategy starts to become impaired by the size of the fund, then they could close to new investors. And for ETFs, they can't do that. So some of the more concentrated strategies haven't come to market in the more niche areas, but there are still, the more broadly diversified active strategies that have done well there. And then the last thing is allocation ETFs. It's sort of a solution in search of a problem, in the sense that like the tax efficiency doesn't always help for allocation, because it's typically going to be in like a retirement account or something like that where it's tax advantage. They might not need the tax efficiency. And then on top of that, it's you're mixing stocks and bonds. You have multiple asset classes. Market makers are going to have to be able to price that portfolio well, hedge it, step in if there's premium or discount. So for market makers to make tight bid-ask spreads, the less complicated, the better. And so it just really hasn't taken off from either an investor interest perspective or in terms of just the plumbing of the ETF market.
So those super specialized options are maybe not attracting.
Right. Yeah.
Got it. So given what Dan mentioned and what you mentioned, it seems like there's lots of pros and cons within the space. Who is a good candidate for this kind of investment? Who can look at the list and say these pros are for me, or who should shy away based on the cons that we just talked about?
Yeah, I think first and foremost, if you're a believer in active management, then this is potentially a good option for you. It's something you would ideally be keeping in a taxable account to really, reap the benefits over a mutual fund. But, when you look at the kind of strategies that might be, conducive for the ETF wrapper, you need to start with, again, is this a good place to go active? And, here I would kind of lean on, we publish an active passive barometer every year where we're comparing, in different Morningstar categories, how active funds perform relative to a composite of their passive peers. So it's a little bit more of a realistic alternative, I guess, than a benchmark. And we find that there are certain pockets of the market where it might make more sense to be active. So that's kind of the place to start before you even make the mutual fund versus ETF decision. Is active a good spot for me? A couple examples there would be international active management tends to be a little bit more successful. Fixed income pretty much across the board, and even in small caps is a little bit easier than something like US large caps where it's really tough to compete. So that's the first step. Number two is thinking about, okay, could some of those drawbacks to the ETF structure really come into play and hurt me here? So, Bryan was just mentioning capacity being a potential issue where, can't close to new investors. If it gets too big, all of a sudden you're running into problems. So if you're looking at something like small cap, which again is very conducive to active management, you might start to run into issues where you really grow out of control, getting a little too big, too hefty to move in and out of new trades easily. So maybe an ETF doesn't make sense there. So I think, was it you that coined active ETF paradox, the term? Kind of the idea there is like, in the spaces where it makes most sense to be active, that might be some of the same areas where it's most challenging to be in an ETF. So there's a little bit of a push and pull to it, and just reiterates the importance of having a look into each strategy on a one-by-one.
Yeah, and we've seen some problems with that, like just recently, right? Like we saw, was the Cathie Wood's ARK ETF had some capacity issues. She started putting a lot of money into like a lot of smaller, stocks that were not really on her radar and stuff like that. So you've clearly seen some problems with some active ETFs.
Bryan, since you coined it, anything to add on the paradox of the ETF, the active ETF?
Yeah, no, not really. It's just, when you think about like large blend is a really good spot for market makers for capacity, and it's the worst area for active managers to sort of seek alpha. So it's really just, it ends up being like a bit of a balancing act for active managers to test where can we add value and where can we effectively deploy the strategy in an ETF.
So as this grows and gains momentum and gains interest from investors, there's bound to be kind of things that get circulated that aren't right, misconceptions. Dan, what would be like kind of the biggest one, the biggest thing that's just wrong that's circulating out in the world?
Yeah, I think the single biggest misconception is just how all of this has been framed in a lot of the media and the headlines and stuff, right? Like you sort of read the headlines and you think, oh, like active stock pickers are all of a sudden having this massive resurgence and they're coming back to life. And that absolutely is not the case, right? So going back to what I was saying before with who are some of the top winners, it's a lot of like rules-based strategies at the end of the day. The stuff from DFA and Avantis, even some of the JP Morgan covered call strategies I talked about before that have been very successful. Those are all essentially like sort of rules-based strategies behind the scenes. They're not really active stock pickers at their core. Now, we have seen some success in those areas. I think of like T. Rowe Price, Fidelity, Cap Group. They've had some decent success there. They've had some ETFs that are doing pretty well. They've got a few billion dollars in them, so they're viable. But it's just when you look at the biggest ETFs out there, it's not this renaissance in active stock picking or active bond picking that the headlines seem to make it out to be. I think that's the single biggest misconception that we need to get clear. It's really more the rules based, will be active around the edges type of stuff at the end of the day. That's and that's great. Those are great investments at the end of the day, by all means. So it's not necessarily a bad thing. It's just misunderstood, I think.
And one thing I wanted to add too is I was shocked when you see the headline numbers. You can just see how explosive the active ETF market has been. But when you dig in deeper, the breadth of success is not really there. There have been a few asset managers that have had a lot of success. There have been a few funds that are just killing it, especially in smaller categories where there's like one or two with over $1 billion in assets, and that's it. And so, and then another thing is just like the innovation of ETFs in general. There's been a big shift into options-based, and so options-based strategies are very high in terms of like their market share of the active ETF market as compared to what you would think of as like active mutual funds, the different areas of the market share there. So it is a little different. It's still very early though. It's 4% of the active market, including mutual funds and ETFs. So it's early days, and these are things that will be fixed over time. But as of now, it's a little tighter on what's been successful.
So we're growing, but we're growing on the margins.
I'll throw one more thing in there too, and we sort of related to, we saw a lot of mutual funds converting to ETFs, or at least it was kind of a hot thing about a year ago, right? It was a big thing. We thought there was going to be, some people thought there was going to be the tsunami of mutual funds converting to ETFs. And it was very much sort of the same story that we're talking about, right? You saw a very limited amount of success. DFA converted, I think it was 7 of their mutual funds into ETFs. Those took off. I mean, it was like they were on rocket fuel. And the rest, I think there was another like 70 or some that have converted since. They kind of just it was like, meh, nobody was really after them. They didn't see them gather a lot of assets. In fact, we actually saw some of them see outflows after they actually converted. So it's not the story that a lot of the headlines are making it out to be.
Got it. It can be tempting to write that headline and say it's huge and it's exploding.
It's very tempting and very clickbaity at the same time, but yes.
So amid all that kind of mediocrity and maybe the ones that aren't doing so well, what is Morningstar like? What are the funds that you think are doing it right, or successful, or well managed? What are you looking at and saying that's the one?
Yeah. So I would put in different strategies in 3 buckets. So Dan referenced dimensional Avantis. That's more like systematic active is what we like to call it. So for those types of funds, obviously dimensional Avantis have had a lot of success. We rate them highly. We think highly of the strategy. It's sort of a mix between active and passive, I would say. There's an active trading component, but it's very formulaic in how they build the portfolios. And so dimensional US core equity 2, for example, is one that we rate highly, and that's almost like a total market, US total market ETF, but they tilt towards things like smaller companies, cheaper valuations, more profitable companies. And then Avantis takes a similar tack, but with Avantis International Equity ETF, but they do a really good job also of navigating through active management some of the inefficiencies, sort of regionally dealing with like local tax laws, things of that nature. So those are really good options for systematic active. The second bucket is the more traditional discretionary active, which 2 that jump out to me are Capital Group Dividend Value, which is relatively new, but we're familiar with the portfolio managers, the teams. It's sort of the strategy echoes of some of the existing American mutual funds. And so, that's a silver rated fund over the past year. It's performed in top 5 percentile of its category. And then Fidelity Total Bond ETF is another one that we think highly of on the fixed income side. And that's a core plus type strategy where they take the sort of the ag sectors where they have government bonds or treasuries, corporate debt, securitized debt, and then they add on up to 20% in high yield or emerging market debt. And so that's another one. And then the third bucket is option space, which, I just referenced. Dan's mentioned JP Morgan strategies. JEPI is a great example. It's the biggest ETF, active ETF, I should say. And what they do is sort of like a fundamental equity sleeve that is intended to be a little bit lower vol, and then they write calls against it, which drives down the beta to the market even further and generates some income. And that's a bronze-rated fund. So we think highly of all of those. And the sort of the unifying characteristic is low fees.
Just
once
to
again,
ask this
yes,
question. Yeah, that was my next one.
No, and I love that you. Sorry to jump in. I like that you bucket it into different degrees of active almost, and it's such an important point because I think so many of us, myself included, sometimes are guilty of just thinking broadly passive or active, just kind of on this binary scale. But there's so much nuance in between, and it's important to kind of sort that out and understand how far away from the market am I really going with something like an Avantis strategy. So there's a whole lot of shades of gray in the middle for sure.
Yeah, it sounded to me when you were laying out the top ones, the ones you like, that there's kind of careful consideration of the active piece of the management of these funds. Is that a fair way to sum it up? Great. And Bryan, maybe you can talk a little about kind of what's next. Are we going to see more funds like these? Are we going to see the industry keep taking off? Is it a flash in the pan? What's ahead?
Yeah. I mean, it definitely feels a little bit like a blank canvas right now. To get back to Bryan's point, you said 4% of the active fund market. I know when you layer in passive ETFs and mutual funds, it sinks down to about 2%. So it's, in the grand scheme of things, still a sliver of the full market available to it. But when I kind of look ahead at the future of the market specifically, we've seen with other iterations of the ETF world before, things like smart beta, thematic funds, ESG, to a smaller scale, kind of had a rise and then a little bit of a trimming where, we saw people fall out of love with them a little bit. Maybe a lot of fund providers realize, just because it worked for some doesn't mean it'll work for us. And you see the market start to tighten up a little bit. I wouldn't be surprised to see a little bit of a narrowing when it comes to just the products available to investors. It's a big lift for fund providers to get an ETF off the ground and stand it up. And it wouldn't shock me to see a lot of them realize it's just not worth the squeeze. That said, it is still such a huge addressable market for active ETFs to take. And kind of the one potential monkey wrench that's out there is this idea of ETFs as a share class, pending approval from the SEC. We don't know if that's going to happen or not. I don't know if I can even speculate on it. But potentially a huge engine there where, a lot of fund providers wouldn't have to go through the process of starting a brand new strategy from scratch, but rather just bolting it on to an existing mutual fund. So if we see that go through, maybe a big inflection point in terms of the active ETF market.
So it might not be the tidy, neat, linear march upward. It could be bumpy or it could, is that?
Yeah, I would almost expect that. I mean, you look at the way it's been so far, it kind of started on this very slow, mild growth. And then the ETF rule was inflection point number one, where you saw the huge jump following 2019. I can't guarantee that ETFs as a share class would have the same impact or anywhere close to it even, but it'd be almost surprising to see a really gradual linear growth for the market.
But we know there's a lot of, at least, interest on the part of asset managers, right? There's something like 17 or 18 filings out there. There were 2 that came out just last week. So asset managers are clearly keen to get on that ride for sure. Yeah.
So as that happens, as the interest grows and as asset managers and advisors kind of take note, what should investors remember? Like if someone's trying to pitch them on an active ETF, or if they're thinking about it or reading headlines, what's the one thing to take away?
Yeah, so I'll give you a short answer and then a long answer. So short answer is when you look at an investment, right, like you have the process and the people, and I think those are going to become even more important as we go forward in the future, right? So if you go back over the last 10, 15, you could even say 20 years, you saw a lot of index tracking ETFs were getting very, very competitive on fees. You'd see Vanguard would cut the fee on Vanguard Total Stock Market by a basis point, and then Schwab would come out 2 days later and do that, and then BlackRock would follow another day or so after that. So you had these fee wars going back and forth on a lot of index tracking ETFs. There were 2 benefits from that. One, you got your index fund for a lot cheaper than what it was before, but it also sort of stiff-armed a lot of the active managers to cut their fees to become more competitive. Now we're sort of seeing a similar dynamic play out with tax efficiency, right? You've seen a lot of index tracking ETFs have had this sort of built-in advantage of tax efficiency in the background. Well, now active managers, now that Ryan said the ETF rule passed in 2019, they can get into ETFs now and they can become more tax efficient in theory if it works with their strategy. So you're seeing that same sort of thing now where they're sort of being forced into the ETF wrapper in order to remain competitive and in some cases remain relevant, I think. So basically what's happening is the playing field is starting to level. Fees are coming down, low fees have become more common, right? Tax efficiency, ETF access is becoming more common. Now that those things are sort of out of the way, now you're going to have to pay more and more attention to what's actually going on in the background. What is the investment process? Who is managing this? How are they trading? All those nuts and bolts, they were always really important. I mean, they're always part of our evaluation process, right? But they're only going to be more and more important going forward as those other sort of, side things that were always sort of an advantage for index tracking ETFs become more prevalent. So I think that's really where this is going. And by the way, that's a great thing for all of us as investors, right? Like, who doesn't want a more tax efficient investment at the end of the day? Who doesn't want lower fees? We know lower fees, all else equal, it's an objective advantage by far. So we should all be jumping up and down as investors because it's a great thing for all of us at the end of the day. I'll drop the mic there on that.
Fantastic. That's a great way to end. I'm looking at our countdown clock, which is rapidly ticking. So thank you, Bryan, Dan, and Ryan, for joining me up here at the Morningstar Investment Conference 2024. That is going to wrap up this week's episode. The team will be taking off next week for our listeners for the 4th of July, and Investing Insights will be back on the 12th. If you're listening, we ask you leave us a 5-star review on Apple Podcasts so other people can find us. And you can watch us on YouTube also, and subscribe to Morningstar's channel to see more of what we do. And then I'll do special thanks to our senior video producer, Jake Van Kersen, our lead technical producer, Scott Halver, our senior audio engineer and producer, George Cassidy, and our associate multimedia editor, Jess Bevel. I'm Sarah Hansen. I'm a markets reporter at Morningstar, and thanks so much for joining us.